This is Oliver Slope with Blue Line Futures coming to you from the floor of the CME here in Chicago with your grain market update. And as you can tell by the tie, it's USDA day. We got the report out, and unfortunately, it was not in the bulls' favor. The ending stocks continues to be a little bit of a thorn in the side. That we also got production raised slightly, but I think all in all, I've seen more bearish reports have a less of a reaction. So I think this might be a little bit overkill, especially with the looming weather going into the weekend and the consistent yield talk that we're hearing from producers across the country, all the way down to Texas, about 20-25 bushels off. But that has yet to be reflected from the USDA, and that's going to take some time to get reflected from the USDA. So don't be thinking that USDA is going to save the day on a month-to-month basis. Now, when it comes to the technical side of things, 377 to 383, this was previous resistance, now becomes technical support. This is a must-hold area going into the weekend. So long as the bulls can defend this, they'll continue the trend of higher lows. Potentially need to get out above higher highs, but that resistance has been stiff at 398 to 401. This is a key Fibonacci retracement, 200-day moving average, and the psychologically significant $4 handle. So that's what we're looking at for corn. Now moving over to the soybeans. Soybeans had a little bit more friendly of a report, but retreating on some spillover pressure from the broader grain complex. 948 to 950 is really kind of the target we're looking at if we can get this market to stabilize. That is the highs from June. On the support side to round out the week, 915 to 920 represents a 50% retracement, or basically the middle of the range from the contract highs to the contract lows, as well as the 200-day moving average. That's a pocket that the bulls must defend going into the weekend to set us up in good shape going into next week's trade. Wrapping things up with the wheat market. Wheat, Chicago failed against our resistance pocket, 5 to 506, which represents the 100-day moving average, 200-day moving average, as well as a breakdown point from that last August USDA report. We're down now towards the bottom end of the range, 480 to 483. This is a 50-day moving average, as well as I had mentioned, the bottom end of the range. That's the line in the sand the bulls need to hold. Now, with that said, we are a little bit more optimistic on the Kansas City contract, especially when you're near this $4 or sub $4. We think that there's a little bit better opportunity from a risk-reward perspective on that front. So that's what we're looking at. That's what you should be looking at too. This has been Oliver Slope with Blue Line Futures from the floor of the CME.